Let's actually start with that, right? And let's get somebody on who is really a keen observer of course, businesses, cycles, but also, I mean, doesn't take his eye off valuation. Sanjeev Prasad is our guest on the program, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good morning. Good to have you with us here on the program. Thanks for your time. So let's just, if you allow me, defense, Sanjeev. It's a large space now. It's not a small space in terms of market cap, etc. What are your thoughts? What is your view? What's to be expected that after Operation Sindoor, there would be a sharp spotlight on this entire space, indigenization, replenishment, etc. But when you're investing, you've got to have an eye on what you're paying as well in terms of valuations. So that's my question to you, Sanjeev.
See, first of all, this theme is great. Obviously, given whatever is happening in the world, geopolitical uncertainty has clearly increased a lot of risk of more conflicts, etc. Obviously, the government of India also needs to do the necessary and invest more in defense. Having said that, there are three important things to keep in mind. The nature of future warfare is going to be very different from what we have seen in the past. So whether India should be investing in conventional, weapon systems or completely new weapon system, that is up to the government to decide. But one thing is becoming more and more clear, war is going to be very, very different in the future. And as you would have noticed, some of the hardware, which was very, traditional hardware, which was used in, let's say, most of the traditional wars, they have all proven to be rather useless in the new kind of warfare that we are seeing. Biggest example is tanks, as an example. They got badly exposed in the Russia-Ukraine war. One precision missile, even from a shoulder-launched rocket, can take out a tank now, and you're wasting so much money over there. Similarly, if you look at aircrafts, they're really as useful as they used to be in the past, given the fact that you have drones which seem to be a lot more, useful, much more cheaper. Battleships, again, a big question mark. They are very slow-moving, and again, given the nature of warfare, could be badly exposed, against missiles and drones and missiles, But there has to be rethink in the kind of equipment that India needs to have, obviously, and accordingly, investors also need to take a call, whether they should be investing in the traditional hardware type companies or in the newer, companies which have, weapon systems which are more, designed for the modern warfare, which could be very, very different from the conventional war. So that number one.
Yeah, Sanjeev, and by the way, we should have all the defense stocks at the bottom of the screen because... or maybe on the side, if we are already showing it, because that, once again, is the sector of the day by far. And many new names have now joined the leaderboard here. What should investors do, though, Sanjeev? Again, it's come down to what company, what are you paying? So what should investors do, viewers who are watching?
It's a very, very tough call. People are simply buying into narratives. See, first of all, what will the government, who will the government give orders to? How do you know, first of all? People just buying anything and everything without looking at, whether the nature of warfare is going to be the same as in the past as explaining. Second thing, whether the kind of EBITDA margin many of these companies are earning, whether that will sustain in the future or not, and I'm surprised to see the kind of very, very high margins this company are reporting, so that could also come under some question mark. And the third is obviously the valuation part, which every investor has to look at ultimately, right? Ultimately, you are paying for whatever you're buying, and you look at some of the numbers they make, really, very little sense to me, at least. If I look at, let's say, something like Upadhyay shipyard, since you talked about that, the market cap is somewhere about 55,000 crores. The net worth is only, by the way, 1,300 crores. Once again, and the profit which it had done, not much this year. So that's the whole struggle for me. When I look at many of these companies, that kind of valuation these companies are starting to get now doesn't make really much of a sense, to be honest with you. Sorry, Kotak shipyard. 800
crores. Sanjeev, 800 crores in profits.
Yeah, 800 crores profit, 55,000, so that's 70 times, right? Net worth is about 50 billion, so 5,000 crores, 55,000 crores market cap, so that's 11 times, net worth. Is that really such a valuable company? I don't know. Maybe in the future we need a lot more orders, and it needs a lot of orders to justify the kind of market cap the company is trading at in the context of the net worth or the PAT, whichever way you want to look at it. There are many such examples, Mazgaon Dock, 1,40,000 crores market cap, 5,600 crores net worth, that's it. I don't know, I only have the 9-month numbers. PBT was about 2,700 crores. Investors can take the call on valuations, and decide whether it makes sense or not.
So what is a reasonable valuation to pay in that sense, Sanjeev? Or is there one? Or how do you assess?
It depends on the type of company, and I can't make a generic,
No, you have coverage on anything, Sanjeev, here? I think BEL, etc. you would.
BEL and Kotak Shipyard.
If I could just, ask a final question on this and then we'll move on, Sanjeev. Again, one of the narratives or one of the talking points that I heard in the last couple of weeks was that you need to go beyond just looking at P&L and traditional price to earnings while looking at the defense opportunity. These are very large order books and the money will come, but it'll take time for the order books to translate into P&L. So this gentleman was talking about not ignoring the large order book while deciding on whether the stock is overvalued or not. Your thoughts?
Sure, you can do some sort of a DCF even for the order book and figure out whether it makes sense or not. I mean, look at, for example, aircraft carrier, which was everybody hoping for Kotak Shipyard will get and make. This story has been going around for 2 years now. Look at the cost of building an aircraft carrier. It will be somewhere about 50,000-60,000 crores. Yeah, to take 10% PAT margin. Yeah, you will make about 5,000-6,000 crores. That's it. I mean, that's the total value which you will get from making an aircraft carrier. And that is assuming you build it today. If you build it over 10 years, which is probably the most likely time frame, then PB of the 5,000 crores of that opportunity which Kotak Shipyard has for making a new aircraft carrier will be far lower. So you have to, even if you take whatever order book you're expecting, take the reasonable profit margin, discount it to today, there is no way you can justify this kind of valuation.
That's a strong argument and absolutely one that we've taken on board. And I think investors need to hear all sides before they decide what they want to do, because the stocks have indeed run up big time. Okay, that's a lot of defense, Sanjeev. Now let me broaden this out. Let me ask you about the market as a whole. The thing is that I think in an environment where not too many sectors are giving you growth, maybe that's why people are latching on to wherever they see opportunity. Overall, how do you rank the earnings season and what lies ahead? Do you see at least 12% earnings in FY26 and then tie that with the market valuation?
12% looks too optimistic, I would say. We have only 10% now for FY2026. That's for the Nifty 50 index. And that is also at some risk because we don't know what happens to many of the global sectors eventually, in terms of growth, given the challenges which many of the countries are facing. You have a lot of uncertainty on the trade tariff issue, which I will talk about later on. So in that context, 22p for the market on March 26 looks on the higher side. The more important thing is not to look at the index as a whole, because anyway, you're not going to buy the Nifty. You're not going to buy the stock. The bigger problem still remains. I made this argument several times. And in most cases, multiples are significantly higher than historical levels, or far lower growth and a lot more uncertainty, far higher global interest rates. So in that context, many of these stocks don't really make any sense. When we look at Indian consumer staple company, most of us are trading between 40 to 60p. The kind of volume growth this company reporting is, lever is down to 2% now. Nestle had hardly any growth last year. I mean, hopefully things will recover. But even if they go to, 4-5% volume growth, some inflation, some premiumization, it is very tough to justify, 50p multiple now. If you look at when they were trading at 50p multiples, they were going much, much faster. So that is the whole challenge. And this is true pretty much across the board. Every sector, you're seeing the same problem of very, very high valuation.
Yeah.
I mean, the market, obviously sentiments have changed very dramatically. In the last 1 month or so, we have gone from absolute despair around when the reciprocal tariffs were announced to some amount of relief when the reciprocal tariffs were suspended to complete euphoria now. Now, if you look at the reality, what has changed? All we know is that the reciprocal tariffs have been postponed. They have not been removed. And I think investors need to really appreciate this basic point that we are on hold for 90 days, 40 days already over. We need to see, where tariffs settle finally. All sudden, tariffs will be higher than wherever they were before this whole saga started. Yeah. So that is not good for growth. That is not good for inflation. That's for sure.
At the beginning of this year, and this is the point we put out in the morning, the beginning of the year, US effective tariffs on China were 11%. They are 39% now, after the deal, which happened last weekend.
And this is a lot, by the way. The prices will go up a lot in the US, so inflation will be there. Some investors are simply not bothered about any of this facts. People assume that, all the problems we saw, which is what worries me a little bit over here, that, incremental news have been positive. If I take it from April 8th, let's say, which was, just before the local tariffs were suspended. But incremental news, if I compare with the beginning of the year, is very negative. So how do I reconcile the two things, right?
Sure. Sanjeev, very quick two-part question. First part is, so you're saying 10% earnings growth this year. Nifty is already at 25,000. So flat for the rest of the year? I mean, just in terms of a market move?
Surabhi, I'm not somebody who forecasts prices. All I know is that, valuations are expensive. Fair value of most of the large cap names are near, current prices or, the current prices are well above fair value in many cases. That's a struggle as of now. On any bottom-up first principle basis, it's tough to justify the current market caps of pretty much, I would say, 90-95% of the market.
Wow, tough to justify the market cap of 95% of the market. That's saying something. So that my second part of the question now.
I can have any debate with anybody on this point. So
I would love to have that. I think we'll do that in one of these days. But the second part of my question is that are foreign flows the only risk to the narrative, to the whole very strong and very logical argument you've made? Because those dollars have started coming in for other reasons, because of growth concerns in the US, tariffs in the US. Could that be an upside risk, maybe a pleasant upside risk from the investor's perspective?
Everybody is taking the call that US will not do well. US is up significantly, by the way.
That's
US
true.
index, S&P index is up 19% from April 8th, by the way. India is up only, I think, 11 or 12%, something like that. So this whole belief that somehow US will not do well and India will do well, I don't know where that feeling is coming from, right? Actually, the S&P is far higher. It's almost close to its peak. So is the Indian market. So what has changed? Nothing has really changed. So there's an assumption that India will get a lot of money. I don't know where it is coming from. And ultimately, foreign investors do look at valuations, right?
Yeah.
Valuations are high. I think there is no debate in this. Second view about that. Anybody is saying that valuations are cheap needs to get his or her head examined, in my view.
Point taken, Sanjeev.
To be honest with you now, yeah.
Yeah, just a very, very briefly, Sanjeev, you put out a note essentially looking at the retail investors and what they are doing, right? You said that they've increased redemption in mutual funds, they've increased selling in direct equities, increased SIP contributions, but they stay invested in narrative stocks, which makes for a heady, for an interesting cocktail and possibly a hangover. So, which is the weak link in these four things? The last one?
Retail investors' flows, not that I'm a great believer in flows as a driver of market, ultimately changing expectations matter a lot more. For whatever it is worth, anybody who believes that retail has been the driving force of this market, which it has been some extent, at least until recently, they were price agnostic buyers, their sentiment has started to weaken for sure. If I look at the data of direct, that is activity of retail investors in the market, that number has been negative for the last 3 months now. That is, they've been selling and FPIs and DIs and others have been buying. Second thing, look at mutual fund flows. They have started to slow down compared to, let's say, the 6-month average of October 24 to March 25. The April number was about 1/3 lower. Main numbers from whatever we can track seem to be not looking very good, and that's it. We're getting from other some of the mutual funds also. So the whole point is, is a section of retail investor community getting a bit concerned about the market for whatever reason? Market has gone up sharply. Maybe some of them are using that to exit, etc., etc. At the same time, we are seeing a lot of action once again in what I call the narrative stocks. Some of the names which you talked about. So I don't know. On the one side, a section of retail investors seem to be getting cautious, looking at the flow data. Other side, if I look at the activity in some of the narrative stocks, which honestly have struggled to justify valuations of, one set of investors seems to be pretty bullish or very bold, in fact. So I don't know how to reconcile the two things. Obviously, retail investors is not one uniform mass. We have different types of people, different risk-taking abilities, and so on and so forth. One set seems to be getting more cautious. Another set seems to be getting a lot more bullish. Let's see.
All right, Sanjeev, appreciate you joining in. Thanks a lot for giving us that commentary. We look forward to having a chat with you as the year progresses.